Spot Bitcoin ETFs are buying more BTC than miners create on many days. When structural demand outruns new supply, the price doesn't grind, it reprices. Today, I'll show you the data, the traps, and the 4 signals to watch this week. Welcome to the Satoshi Shift. We decode real market structure, not hopium. If you take Bitcoin seriously, this one is a must-watch. Like, subscribe, and hit the bell. It helps the channel reach more serious investors. So, what changed? A spot ETF means institutions buy actual Bitcoin held in custody, not paper futures contracts. That unlocked 3 new pipes. First, access, registered investment advisors, retirement accounts, and family offices can now get exposure. Second, friction. It's now click to buy inside existing broker apps. No seed phrases, no new accounts. And third, legitimacy. The compliance and custody standards reduce the career risk for professional allocators. ETFs turned Bitcoin from a tech niche into a ticker inside traditional finance. Now let's look at the supply math. It's pretty simple. Post-halving, miners issue about 450 new BTC per day. If the average daily net inflows into the ETFs beat that number, the available circulating supply on the market tightens. This forces price discovery to shift upward to find new sellers and clear the demand. When inflows are greater than issuance, dips are usually shallow and get bought up quickly, until those flows flip or a major macro event hits. But it's not just about fewer new coins. A huge slice of the existing supply is illiquid. It is held by long-term holders who barely move their coins, even at new all-time highs. Imagine a game of musical chairs where more and more players are entering the room, but the number of chairs is shrinking. When fresh buyers are fighting over a dwindling pool of liquid coins, markets don't climb slowly, they jump. The halving also changes miner incentives. They earn fewer block subsidies now, so their behavior has to adapt. They've become much more sensitive to transaction fees and the Bitcoin price. Weaker, less efficient miners are now forced to sell into strength to cover their costs. This means swings in hash price, the revenue miners earn per unit of computing power, can shift the timing of when they sell their holdings. You should expect tactical miners selling on green days. The key is to track it, not fear it. This bullish structure doesn't mean there's no risk. In fact, most people skip this part. You need to watch for ETF outflows. The same pipe that pumps can drain, and it can drain fast. Macro liquidity is also a huge factor. Interest rates, quantitative tightening, or easing, and the strength of the dollar all shift the market's appetite for risk. A single regulatory headline can pause flows instantly. And don't forget legacy overhangs, like creditor distributions from old bankruptcies, which can add sudden supply to the market. Finally, watch leverage. Hot funding rates plus high open interest is the perfect fuel for a cascading liquidation event. Remember, ETFs reduced career risk for buyers, but centralizing the flow of funds creates a new potential point of failure. So, how do you navigate this? You need to operate with a checklist, not just vibes. First, access. Decide consciously between the convenience of an ETF and the sovereignty of self-custody. Second, strategy. Dollar cost averaging lowers stress, while a lump sum carries timing risk. A hybrid approach often fits most people. Third, guardrails. Set clear position sizing rules, define your time horizon, and keep your emergency cash separate. And here are the 4 key signals to check every single week. First, ETF net flows, which you can find on Farside or SosoValue. Second, exchange reserves and stablecoin flows, using data from Glassnode or CryptoQuant. Third, leverage metrics like funding rates, open interest, and perpetual skew from CoinGlass or Levitas. And fourth, long-term holder distribution versus accumulation patterns from Glassnode. You can screenshot this checklist. If the flows are on your side, you don't need to nail the perfect entry. Now, here's your invalidation checklist. You should flip to a defensive stance if you see these signs. 1. Sustained ETF outflows over several days. 2. Exchange reserves begin to rise, suggesting more people are preparing to sell. 3. Leverage gets hot, with funding rates climbing and open interest spiking. And 4. The price stalls or diverges from the strong underlying data. When you see 3 or more of these signals line up, it's time to reduce risk and wait for the market to reset. Discipline always beats prediction. The bottom line is this. ETFs opened a fire hose of demand into a shrinking pool of liquid coins. When structural demand outruns new issuance, markets don't drift. They reprice aggressively. Your job is to track the flows and respect the risks. If you want to deep dive next on Bitcoin L2s and BitVM, can DeFi finally come to BTC? Comment Shift below. I'll feature the best comments in the next video. And as a reminder, this video is for educational purposes and is not financial advice. Thanks for watching, and I'll see you in the next one.